Hello everyone and thank you for watching Edupedia World videos. Today in this class we'll continue with the basic concepts of the income tax law in India. We'll continue with our introduction to various definitions and various terms used in taxation system in India. So let us start with our class. The learning objectives for today's class. What will be the learning objectives in today's session? Number 1, and we'll understand the procedure for computation of total income for the purpose of levy of income tax. That is, we'll go through step by step how the total income is calculated and how income tax is levied upon it. There are different steps in which the income tax is calculated. So we'll go through each step one by one. The first learning objective will be that. The second will be, we'll know that there is a requirement of paying advance tax and deduction of tax at source. This is the second objective we'll go through in this class. What is advance tax? What is deduction of tax at source, that is TDS. And lastly, we'll know what a return of income is. So what does the return of income means? We have to file it, we have to just show our income in the return of income, etc. etc. We'll go through it as we proceed. So these are the three learning objectives for today's class. Number 1, to understand the steps, the procedure for the computation of total income and how income tax is levied upon it. Number 2, the definition and purpose of advance tax and TDS. And number 3, what is a return of income is. So these are the three learning objectives for today's class, and at the end of the class we'll be able to understand and know what does these three means and how these three are calculated. First of all, let us come to the first learning objective for today's class, that is, how is the total income of an SSC computed and the tax is levied on that total income. So we'll first understand the various steps involved in the computation of the total income for the purpose of levy of income tax on it. Income tax is levied on an assessee's total income. Such total income has to be computed as per the provisions contained in the Income Tax Act 1961. So, we have to compute the total income as per the provisions given in the Income Tax Act. So, from the next slide, we'll understand what are the various provisions given and how according to it, the total income of an assessee is computed. Let us go step by step to understand those procedures for the purpose of levy of income tax on it. The first step in the computation of the total income of an assessee is the determination of residential status of the assessee. This is the first step in the series of steps that we have to follow for the computation of the total income. The residential status of a person has to be determined to ascertain which income is to be included in computing the total income. This is the main reason for determination, because in the Income Tax Act 1961, the laws and the provisions given is about an income is that if a person is a resident, then this income has to be included. And if a person is a non-resident, then the same income will not be included. So, for that purpose, the residential status for any person has to be determined, because the same income will become the income for a resident, but it will not become the part of the total income in case of non-resident. So, this purpose is served by understanding and by knowing the residential status of any person. Unless and until we know the residential status of any assessee, we will not be able to know that, okay, this income needs to be included or not in the computation of total income. So, it's the step number 1 and a very important step for the computation of total income. The residential statuses as per the income tax are shown below in the given chart. It says that the residential status is divided in two broad categories, that is resident and non-resident. These are very common, and in common parlance also we use these two terms, resident and non-resident. So these two does not need much of explanation. But resident is further subdivided into two categories, that is resident and ordinarily resident, and resident but not ordinarily resident. So these two are new terms for you all. So we'll just understand these two terms in detail in the coming slide. That what does resident and ordinarily resident mean, and resident but not ordinarily resident means. If a resident is resident and ordinarily resident, then some incomes will be included in it which will not be included in residents but not ordinarily residents. So an income is included in the assessee's total income depending upon whether he is ordinarily resident or not ordinarily resident. Just being resident is not enough. We have to further determine that whether he is ordinarily or not ordinarily. So if we just determine that okay, this person is a resident, so we have to further determine that whether this person is ordinarily resident or not ordinarily resident. But if a person is non-resident, then we don't have further problems. We'll simply just know that what incomes need to be included and what incomes are excluded as per the provisions of the income tax law. So this is the first step in the computation of the total income to determine the residential status of the assessee. Now we will understand how the residential status of an assessee is determined. In case of an individual, the duration for which he is present in India determines his residential status. So, the period for which, the number of days for which he is present in India in a particular year determines his residential status. All the details about the how many days a person need to stay so that he is a resident and ordinarily resident and not ordinarily resident or not non-resident, all the details we will discuss in the second unit, that is when we'll discuss the definitions of the various terms. But for now on, we'll just know that it is the duration. This word is important. The duration for which an individual is present in India determines his residential status. Based on the time spent by him or her, he or she may be a resident and ordinarily resident, a resident but not ordinarily resident, or a non-resident. All these categories depends upon the time spent by an assessee in India. So, if he spends this much time in India, then he is resident and ordinarily resident. If he does not spend this much time in India, then he is not ordinarily resident, and if he spends very less time in India, then he is a non-resident. Like, we will discuss all the criteria for determining these three categories, but for now on we just need to know that it is the duration which determines the residential status. The residential status of a person determines the taxability of the income, as we discussed in the previous slide, that until and unless we just know what is the residential status of an assessee, we will not be able to determine that what income is taxable and what income is not taxable. So for that we need to know the residential status of any assessee to just bring under the purview of taxability the various incomes. For example, income earned outside India will not be taxable in the hands of a non-resident, but the same income will be taxable in case of a resident and ordinarily resident. So, if I am earning some income outside India and if I am a non-resident, then that income will not be taxable in my hands. But if I am a resident and ordinarily resident, then the same income will be taxable in my hands. So the residential status is very important in determining the taxability of various incomes. After determining the residential status of an assessee, now we'll just classify his income, the various incomes earned by him during an year, into these 5 following heads. This is the step 2 in the computation of total income, that is classification of income under different heads. Now, when we have determined the residential status of an SEC, the second thing that we will do is we will just divide the various incomes earned by him in an year into these five following heads. What are they? Number 1, salaries. Number 2, profits and gains of business or profession. Number 3, income from house property. Number 4, capital gains. And last and number 5, income from other sources. Whatever income he earns during an year is divided into these 5 heads. We'll just classify all the incomes he has earned in an year into these 5 heads, and then accordingly those incomes will be taxed as per the provisions of these heads. That is, salaries will be taxed according to the provisions given in salaries, taxation of salaries. PGBP will be taxed as per the provisions given in taxation of PGBP, and so on. So this is the second step in computation of total income, that is, we'll classify the income under various heads. These heads of income exhaust all possible types of income that can accrue to or that can be received by a taxpayer. These major heads of income exhaust all possible type of income, that whatever income is being earned from whatever source can be divided into these 5 heads. So these heads are exhaustive, that apart from these types of income, no other type of income can be earned by any SSC in a given year. For example, salary, pension earned, etc. is taxable under the head salaries. Rental income is taxable under the head income from house property. Income derived from carrying on any business or profession is taxable under the head profits and gains from business and profession. So these 3 heads exhaust these types of income. Profit from sale of a capital asset like land, building, jewelry, etc., bullions, everything, whatever capital asset we are possessing, if we sell them and we earn profit, then that profit is taxable under the head capital gains. The fifth and the last head of income is the residuary head, under which income taxable under the Act but not falling under the first 4 heads will be taxed. So the fifth head is the residuary head, in which that if the type of income earned by any SEC does not fall under the previous 4 heads, that income will come under the 5th head. That's why it's called income from other sources. Whatever income is being earned by the sources which are not the previous 4 sources, then that income will be taxed under the 5th head, that is income from other sources. The taxpayer has to classify the income earned under the relevant heads of income. It's my duty to classify the various income earned by me during the year into these 5 heads, and then we'll proceed with how the various heads of income will be taxed. Now we come to step 3. After determining the residential status and after classifying the various income into the 5 heads of income, we'll just determine that what income earned by us is not chargeable to tax. That is, we will exclude the incomes which are exempt from tax. There are certain income which are wholly exempt from income tax. For example, agricultural income. If we are earning any agricultural income, then that income is wholly exempt from income tax. That is, we don't have to pay tax on it. These income have to be excluded and will not form part of gross total income. We have to exclude all these incomes which are not chargeable to tax from the gross total income, and the income which will remain after excluding these incomes will be taxable. Also, some incomes are partially exempt from income tax. For example, house rent allowance, education allowance. These incomes are excluded only to the extent of the limits specified in the Act. Now, there are some incomes which are wholly exempt, like agricultural income, and there are some incomes which are partially exempt from income tax. That is, there is a limit specified in the Income Tax Act that, okay, until this limit, these incomes will be exempted, and after that they will be included in the total income. So these are partially exempted income which have to be excluded up to a certain limit, and after that they have to be included. The balance income over and above the prescribed exemption limits would enter computation of total income and have to be classified under the relevant head of income. That is, these house rent allowance and education allowance, these are partially exempted. So up till they are exempted, that part has to be excluded, and after that the part which has to be included has to enter the computation of total income, and these have to be classified under the relevant head of income. Like this HRA and education allowance forms part of salaries. So the part of HRA which is taxable will be classified under the head salaries, and accordingly it will be taxed. So the step 3 of computation of total income is the exclusion of incomes not chargeable to tax, whether wholly exempt or partially exempt. If they are wholly exempt, then the whole part is just excluded, and if they are partially exempt, then that part which is exempted is excluded. Now comes step 4, computation of income under each head. After determining the residential status and after dividing the various incomes earned by an assessee into the various heads of income, and thereafter excluding the income exempt from taxation, we do the computation of income under each head. After just dividing the income into the various heads, we just compute income under each head. Income is to be computed in accordance with the provisions governing a particular head of income. As we discussed in the previous slide, that under each head there are provisions of computation of that head of income. So if I am earning income as salary, so I have to compute my income as per the provisions given under the head of income salary. Under each head of income, there is a charging section which defines the scope of income chargeable under the head. Under each head, there is a charging section, like what part of your income will be charged to income and what portion of your income will come under the purview of taxation. So under each head there is one charging section, and they also prescribe the rates at which your income will be charged, and they will give the various deductions and allowances prescribed under each head. Like salaries, we have house rent allowance, education allowance, and so many different type of allowances that are deducted from your salary, and the remaining portion is only taxed. Similarly, while calculating income from house property, municipal taxes and interest and loan are allowed as deduction. So we have these types of deductions and allowances in each head of income. The next step in line is clubbing of income of spouse, minor child, etc. What this step means. What happens is that in case of individuals, income tax is levied on a slab system. Every year in the Annual Finance Act, the Finance Minister introduces a slab according to which the income of an individual is taxed. In this year's budget, the slab is like that if you are earning till 2,50,000, that is your gross total income is 2,50,000, then you have to pay no amount as tax. If you are earning between 2,50,000 and 5 lakh, you have to pay 10% of your income as tax to the government. If you are earning 5 lakhs, between 5 lakhs to 10 lakhs, then you have to pay 20% of your income as tax. And if you are earning 10 lakhs and above, you have to pay 30% of your income as income tax to the government. So the tax system is progressive. What we see in this slab is that the tax system is progressive. As the income increases, the applicable rate of tax increases. So what happens is that some taxpayers in the higher income bracket have a tendency to divert the portion of their income to their spouse and minor child in order to minimize their tax burden. Obviously, if I am earning more, I would like to keep more money with myself rather than paying it in the form of income tax to the government. So what I do, I just divert my income and show that income as my spouse income, as my minor child income, so that that portion of income is not taxed and that portion of income remains untaxed and remains with me only rather than paying it to the government in the form of income tax. So in order to curb this tendency, the government has introduced some measures such that clubbing of income. What the government do, that if they find that any assessee has diverted his income towards his spouse or minor child, so that income will also be considered as the income of the assessee only, so that this tendency is curbed, the tendency of diverting. If the government finds that okay, this assessee is diverting his portion of income so that his income is untaxed and his income remains away from this taxation thing, then the government just clubs that income of spouse and minor child with the assessee only. So, in order to prevent such tax avoidance, clubbing provisions have been incorporated in the Act, under which income arising to certain persons like spouse, minor child, etc., have to be included in the income of the person who has diverted his income for the purpose of computing tax liability. That is, the person diverted the income to the spouse and minor child, but that income will be clubbed with his income and accordingly his tax liability will be computed. Now we come to step number 6, that is set off or carry forward and set off of losses. What does this step mean? Now, what happens is that an assessee may have different sources of income under the same head of income. Like under the head profit and gains of business and profession, he might have profit from one source of business and loss from the other source. For instance, an assessee may have profit from his textile business and loss from his printing business. For example, he is carrying on two types of business. One is textile and one is printing. He is earning profit in the textile business, but he is incurring loss in the printing business. So this two type of business, these two sources of income is coming under one head only, that is the PGBP, profit and gains of business and profession. So according to the provisions of the income tax law, this loss from the printing business can be set off against the profit of the textile business to arrive at the net income chargeable under the head profits and gains of business or profession. Get it? The loss from the printing business will be set off against the profit of the textile business, and the remaining income, the resulting income, will only be chargeable under the head PGBP. So this is we call set off. Now, as we read in the previous slide that income from the same head of income can be set off against each other. Like income under the same head of PGBP was set off against each other to arrive at the net income. Now, similarly, an assessee can have loss under one head of income, say income from house property, and profit under another head of income, say profit and gains of business or profession. So there are provisions in the Income Tax Act for allowing inter-head adjustment also in certain cases. So the profit of PGBP can be used to set off the loss of income from house property. Previously we just studied that how income from the same head can be adjusted. Now there are provisions in the Income Tax Act which allows adjustment from other heads of income also. Say that the loss from the house property business can be set off against the profit of the PGBP business, like profits which we earn from business or profession. So the Income Tax Act have such provisions. Further, losses which cannot be set off in the current year due to inadequacy of eligible profits can be carried forward for set off in subsequent years as per the provisions contained in the Act. It may happen that after all adjustment also there are losses only. They are incurring so much losses that the profits are not enough to set them off. So what happens is that these losses can be carried forward. These losses which are just so many that there are not eligible, like the profits are not adequate to set them off. So these losses can be carried forward in the subsequent years, and in subsequent years they can be set off against the eligible profits. So there are provisions of such type of carrying forward also in the Act. Now comes the step number 7, that is the final computation of gross total income, that is after giving effects to all the deductions, allowances, after giving effect to the provisions of clubbing and set off and carry forward, the final figure which comes under each head of income is then added to arrive at the gross total income. So, we'll read the step, whatever is given here. It says that the final figures of income or loss under each head of income after allowing the deductions, allowances and other adjustments are then aggregated, that is added, after giving effect to the provisions of clubbing, set off and carry forward to arrive at the gross total income. So, in step number 7, we just calculate the total GTI, that is gross total income. After just calculating income under each head, we add them up to arrive at the total income. After calculating the total income, that is the gross total income, adding up all the incomes from various heads, we just deduct some deductions which are prescribed from the gross total income. That there are some deductions and allowances under each head, but now there are some deductions which are allowed from the gross total income, that is from the total income. Those deductions and allowances which are allowed under each head of income are different, and these deductions are different. So, from the gross total income, the deductions are allowed. The deductions can be of 3 types. Deductions in respect of certain incomes, deductions in respect of certain payments, and other deductions. Deductions in respect of certain incomes can be, for example, profits and gains from industrial undertakings or enterprise engaged in infrastructure development. Means that if I am engaged in a business of infrastructure development and I am earning profits and gains from that, then those incomes will be deducted. For example, another example is that I am engaged in an development of special economic zone, that is SEZ, then those profits will be deducted. Certain incomes of cooperative societies are deducted. Royalty income of authors of certain books are deducted. Royalty on patents. So all these are deductions from income. These are deducted from the gross total income. Deductions in respect of certain payments are, for example, LIC. The LIC premium we pay, that is a deduction from the gross total income, that is an allowed deduction. Contribution to provident fund, pension fund, medical insurance premium, all these types of premium are allowed as deductions under different sections of the Income Tax Act, which we will read in detail as we continue with the classes. There's a different section only, a different chapter, chapter 6. These deductions are covered under chapter 6 of the Income Tax Act, and different sections, that is 80C, 80CCC, 80D. So these sections give the various deductions allowed in respect of payments. So we'll go through it in detail after we just proceed. So these are the deductions which are in respect of certain payments allowed from the gross total income. And other deductions are the residuary deductions, that are some rare deductions given. For example, deduction in case of a person with disability, that is section 80U. So if a person is suffering from any disability, his income will be deducted. So all these types of deductions, that is deductions in respect of payments, in respect of incomes, and other deductions, these are deductions allowed from the gross total income. Step number 9, that is total income. The income arrived at after claiming the above deductions from the gross total income is known as the total income. Now, after just claiming all the deductions as we discussed in the previous slide, we come to a figure known as the total income. Now we are proceeding towards the end of our steps. How we started with knowing the residential status and then dividing income into various heads, excluding the exempted income, and so on. We have reached till the last step, and that is how we will calculate the total income. After deducting all the deductions from the gross total income, we will arrive at the total income. It should be rounded off to the nearest multiple of 10. Total income that we will arrive at after deducting should be rounded off to the nearest multiple of 10 if it is not in the multiples of 10. So now we will just go through one by one all the steps that we read till now. We started with step number 1, determination of residential status. Then we classified the income under the 5 heads, that is salaries, house property, PGBP, capital gains, and other sources. We classified them under the following 5 heads. Then we aggregated the income, that is, we removed the income which is not taxable, which is exempt partially or wholly. We just removed that income from our taxable income, and then we applied the clubbing provisions, that is, the income which is diverted by the SSE to the spouse and minor child, that is clubbed. Then we applied the set off and carry forward, the income from one head and the loss from another head, or the income from one head and the loss from the same head can be set off, and still there are some losses which cannot be set off against the profits, or there are inadequate profits that can be carried forward to the next year, so on. We discussed that provision, and then we arrived at the gross total income after giving effect to all these steps. And then from that we had some deductions in respect of payments, income, and other deductions that we deducted from the gross total income, and then at last we arrived at the total income, and that income will be taxed as per the provisions of the income tax. So till step 9 we are able to calculate the total income, and now we will start with steps of calculating the tax levied on the total income. Now we come at the application of rates of taxes on the total income. After we are done with the calculation of total income, now comes the taxation on the total income. The rates of taxes for different SSE will be applied on the total income of different SSEs to arrive at their respective tax liability. The rates of tax for the different classes of SSEs are prescribed by the Annual Finance Act. The Finance Minister in the Annual Finance Act prescribes rates for the taxation of different SSEs like individuals, HUFs, companies, etc. Different rates are prescribed for different SSEs. For individuals, HUFs, etc., there is a slab rate and basic exemption limit. Like we discussed previously, that the slab rate for individuals, we have discussed that till 2,50,000 there is no taxation. That is, you have to pay no tax if you are earning 2,50,000 or you are earning till 2,50,000 in an year. So if that is the case, then you have to pay no tax. Likewise, if your income exceeds 2,50,000 and is within 5 lakhs, you have to pay tax on the total income in excess of 2,50,000 at the rate of 10%. Like if I am earning 2,60,000, so I have to pay income on only 10,000, that is 2,60,000 minus 2,50,000, that is 10,000 at the rate of 10%. So whatever I am earning over and above 2,50,000, I have to pay tax on that amount at the rate of 10%. The highest rate is 30%, which is attracted in respect of income in excess of rupees 10 lakh. As we have discussed earlier that till 2,50,000 no tax, from 2,50,000 to 5 lakh 10%, from 5 lakh to 10 lakh it is 20%, and the highest is 30%, that is applied when you are earning over and above 10 lakhs. So this is the case of individuals. For firms and companies, a flat rate of tax is prescribed. That is, for individuals and HUF, there was a slab that was progressive in nature. Okay, if you are earning this much, you have to pay this much tax. If you are earning more than this, then you have to pay this much. And if you are earning more than that also, then you have to pay this much. But for firms and companies, the tax rate is flat. At present, the rate is 30% on the whole of their total income. So if a company is earning anything, then they have to pay a flat rate of 30% of their income as income tax. The tax rates have to be applied on the total income to arrive at the income tax liability. Step number 11. Surcharge and rebate under section 87A. What do we mean by surcharge? First of all, we know the definition. Surcharge is an additional tax payable over and above the income tax. Like after we have calculated the income tax payable according to the rates prescribed, we have to calculate surcharge, which is an additional tax. Surcharge is levied as a percentage of income tax. Income tax is levied on income, and surcharge is levied as a percentage of income tax. Like the total income tax which I am liable to pay, on that I will apply the percentage of surcharge to calculate the total tax. In case where the total income of an individual exceeds 1 crore, surcharge is payable at the rate of 10% of income tax. That is, if I am a super rich and I am earning more than 1 crore in a year, so I will be liable to pay surcharge at the rate of 10% of my income tax. That is, income tax, rate of income tax will be applied to my total income of 1 crore and more, and the income tax which will be calculated on that, 10% of surcharge will be levied. 10% of my income tax will be there as surcharge, and that total will be my total tax liability, that is the income tax and the surcharge. The sum total of these both figures will be my total tax liability for the year. As surcharge is applicable for the higher tax paying group, similarly there is a provision of rebate for the lower tax paying group. Surcharge is an additional tax leviable on the super rich. Likewise, there is rebate for the persons who pays and who belongs to the lower slab rate. What is that rebate? In order to provide tax relief to the individual taxpayers who are in the 10% tax slab, that is the persons who are earning between 2,50,000 and 5 lakh. Section 87A provides a rebate from the tax payable by an assessee. Being an individual resident in India whose total income does not exceed rupees 5 lakh, the rebate shall be equal to the amount of income tax payable on the total income for an assessment year, or an amount of 2,000, whichever is less. So, there is a provision which is a newly inserted provision for the lower tax paying group. If I am earning between 2,50,000 and 5 lakh, whatever tax I am liable to pay, I will get a deduction of rupees 2,000 or the total income tax payable, whichever is less. So if my tax liability is coming as 5,000, then I'll get a deduction of rupees 2,000 from it. And if my tax liability is coming as 1,900, then I will not be liable to pay any tax for that year. So this is a rebate introduced by the government, recently introduced by the government. So now we know what is surcharge and what is rebate. Surcharge is an additional tax levied upon the income tax payable, and rebate is a special relief provided to individual taxpayers, the lower tax paying group, by the government. After the surcharge and rebate comes the education cess and secondary and higher education cess. Unlike surcharge, which is just levied upon the super rich and the person whose income exceeds 1 crore, education cess and secondary and higher education cess is levied upon all the taxpayers paying income tax. The income tax as increased by the surcharge or as reduced by the rebate under section 87A if applicable. If applicable means surcharge is only applicable in case the income is exceeding rupees 1 crore, and rebate is applicable only when you are coming under the slab of 2,50,000 and 5 lakh. So after giving effect to these provisions, that is surcharge and rebate, if applicable, the income tax is to be further increased by an additional surcharge called education cess at the rate of 2%. This education cess is to be paid by all the taxpayers at the rate of 2%. The education cess on income tax is for the purpose of providing universalized quality basic education. Like the purpose of the government for levying this education cess is to provide basic education to the underprivileged in this country. This is payable by all assessees who are liable to pay income tax irrespective of their level of total income. As I said, this is to be paid by all the taxpayers irrespective of their total income, unlike surcharge and rebate, which is leviable on a certain class of income tax payers. After the education cess comes the secondary and higher education cess on income tax. This is also a type of cess, education cess levied at the rate of 1% of income tax plus surcharge if applicable. Education cess is levied at the rate of 2% of income tax, and secondary and higher education cess is levied at the rate of 1% of income tax. So, in total, 3% cess is leviable on the income tax. The tax, after the calculation of total income, we apply the percentage of income tax, and that amount which comes, on that we apply the rate of education cess and secondary and higher education cess at the rate of 2% and 1% respectively. It is leviable to fulfill the commitment of the government to provide and finance secondary and higher education. Likewise, in education cess, the government is levying this education cess for providing basic education, and the government is levying the secondary and higher education cess for providing the secondary and higher education. So these are the two types of cess leviable on the income tax payable, and the sum total of these things is finally payable by the assessee. That is the income tax plus surcharge plus the education cess plus the secondary and higher education cess. The sum total of all these things is finally payable by the assessee in favor of the government. Now comes the concepts of advance tax and tax deducted at source. Now we have completed till step 12 all the computations for the calculation of income tax. The sum total of everything, that is income tax, surcharge and both the cess, comes the amount which has to be paid to the government. Now how this amount is to be paid to the government? This is the tax we have to pay for the whole year, but the government has introduced a system of advance tax, meaning you have to just estimate your income and calculate tax, estimated income tax on that, and you have to pay that income tax in installments throughout the year rather than paying it in one installment at the end of the year. Basically, this concept is introduced by the government in order to get a regular income in the form of tax, to just generate regular revenue. rather than just getting the revenue all at once at the end of the year. So the system of advance tax says that an assessee has to pay the tax levied upon him in installments throughout the year. We'll read what is given in the points, then it will be more clear to you. Although the tax liability of an assessee is determined only at the end of the year, tax is required to be paid in advance in certain installments on the basis of estimated income. As I said, that the assessee has to estimate his income on an estimated basis, calculate the income tax on that estimated income, and has to pay that income tax in installments throughout the year, so that the government is able to get a regular source of income. This is the concept of advance tax. Now comes the concept of TDS, tax deducted at source. What happens is that if I am earning salary or if I am a salaried person, I am getting salary from my employer. So the employer is required to deduct some part of my salary as tax and deposit it to the government regularly. Every month I'll get my salary, and every month the employer will deduct some part of the salary as tax and pay it to the government. So that is called tax deducted at source. This is also one way for the government to generate regular income. The government is able to get the revenue regularly in the form of TDS. So advance tax and TDS, both are the ways in which the government is able to get the tax revenue regularly rather than getting it at the end of the year. I'll read it, the point. In certain cases, tax is required to be deducted at source from the income by the payer at the rates prescribed in the Act. The rates of TDS is prescribed in the Act. There are various rates for various payments, like for salary there is a different rate, for rent and for interest, whatever. There are so many things which are liable for TDS. We'll just read it in the further classes. Just now you just need to know the concept of advance tax and TDS. Such deductions should be made either at the time of accrual or at the time of payment as prescribed by the Act. So the tax deductions should be made at the time of accrual or at the time of payment, whatever is given in the Act. So now you know what is advance tax and tax deducted at source. These both are the ways by which the government generate regular income in the form of tax revenue rather than getting whole of the revenue at one point of time. After getting done with the computation of the total income and the computation of tax liability upon it, now comes the return of income, the last topic for today's class. What does the return of income means? First we'll read whatever is given in the slide and then I'll make you understand point by point. Let us read. The Income Tax Act 1961 contains provisions for filing of return of income. Return of income is the format in which the assessee furnishes information as to his total income and tax payable. Now, once we have calculated the total income and upon it we have calculated the tax liability, now it's the time that we furnish that computation and furnish that information to the government. So how to do that? So return of income is our mean to inform the government to furnish the information relating to our total income and tax payable thereupon to the government. The format for filling of returns by different assessees is notified by the CBDT. There are different types of assessees, as we have discussed earlier, that individual, HUF, company, firms, etc. So the format for filing of returns by these assessee is different. That is, individual will file in different format, partnership firm will file in different format, and so on. So the formats have been prescribed for different assessees by the Central Board of Direct Taxes. So now we get it. What is the return of income? Return of income is the format in which the assessee furnishes the information as to his total income and tax payable to the government. It is a format in which we have to intimate the government that what is our total income for the year and what amount of tax we are liable to pay upon it. The particulars of income earned under different heads, gross total income, deductions from gross total income, total income, and tax payable by the assessee are required to be furnished in a return of income. So, what are the things which are required to be showed in a return of income? It is number 1, particulars of income under different heads. The different heads of income, that is salaries, PGBP, capital gains, other sources, house property, all types of income earned. The particulars of each head's income is needed to be given in a return of income. We have to provide the details of each head of income. Then number 2, we have to give the deductions from gross total income that we have learned in previous slides. What are the deductions from the gross total income? So whatever deductions we are eligible to, that we have to show. Number 3, then after the deduction of these deductions from the gross total income will come the total income, that we have to show, and then we have to calculate the tax upon it, the amount of tax we are liable to pay upon the total income earned, that we have to show. So what all things we have to show? Particulars of income earned under different heads, deductions from total income, and then tax payable by the assessee. These all are required to be furnished in a return of income by an assessee. In short, we can say that a return of income is the declaration of income by the assessee in the prescribed format. So, a return of income can be defined as declaration of the total income and tax payable by the assessee in the given format. The Act has also prescribed due dates of filing of return of income in case of different assessees. The Act has not only prescribed the format but also the due date for filing these returns, and the due date is different in case of different assessees. In case of companies and firms, they have to mandatorily file their return of income before the due date. That is, there is no lower limit that if the income is below this or income is this much only, then only they have to file the return. No, they have to file return in every case, whether they are earning income or whether they are incurring loss, whatever the case may be, they have to file their income tax return, and that too before the due date, and otherwise they'll have to pay fine and penalties if they do not file their return of income before the due date. In case of individuals and HUFs, they have to file the return of income if their total income without giving effect to the deductions under Chapter 6A. We have just discussed that the deductions under Chapter 6A, the various deductions from the gross total income, 80C, 80D, 80CCD, everything, like all those deductions which are given in that chapter, which we deduct from the gross total income to arrive at the taxable income. So, if the income of the individual and HUFs without giving effect to these deductions, that is their gross total income, if their gross total income exceeds the basic exemption limit, then only they have to file the return of income. That is, they have to mandatorily file the return of income if their gross total income exceeds the basic exemption limit. If not, then they are not required. That is, that voluntarily they can file, but they are not just required mandatorily to file the return. So, companies and firms mandatorily, and individuals and HUFs are required if their gross total income, that is income without giving effects to various deductions, exceeds the basic exemption limit. That is, what is the basic exemption limit in case of individuals? 2,50,000. If that they are exceeding, then they have to file the return of income. So this is all for today's class. What we learned in today's class, various steps in calculation of income, the levy of income tax on that, and the return of income. Hope you found this class helpful. Thank you.